Welcome everyone. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy at CFA Institute. Today's webinar is on really two important concepts. The first is asset allocation and the second is rule-based investing. And we often forget that it's the returns that we see in the market. They are actually generated by asset allocation rather than by security selection. This is one of the biggest concepts in investing, but we tend to miss that. So this webinar will build on that concept and add many more layers from a practitioner's perspective and from a very experienced fund manager, Ashutosh Bhargava. Ashutosh is the head of equity research at Nippon India Mutual Fund. He also manages and co-manages 5 equity-oriented and asset allocation funds. Ashutosh has over 16 years of experience in research and investing, and his area of expertise is macro and rule-based investing techniques. As you'll see from his presentation, it's filled with many ideas. So pay attention to what he's saying, take down notes, and I think you'll enjoy the session very much. Before we begin, let me come with some housekeeping instructions. Most of you have been attending this, know these instructions. We've got about 1 hour. It will be 30 to 40 minutes of presentation. And Ashutosh has got lots and lots to share, but we'll try to wrap it in 40 minutes. That will be followed by interactive 20 minutes of Q&A. If there's some point that is not clear, I might take the liberty of asking Ashutosh what he means by something during the first 40 minutes. Now, once you are doing in the Q&A phase, right? In the Q&A phase, please, don't wait for the Q&A phase to begin, which is the last 20 minutes. As points come to you, as you think something is important to you, try to put that on the Q&A chat, not on the general chat, on the Q&A page. Okay, that is second thing. And third thing is try to ask questions on the conceptual side of things. That's about it. Without further ado, let me pass it on to Ashutosh. Ashutosh, the stage is all yours. Thank you so very much for all of this.
Thanks a lot, Srinivas. Let me, quickly jump in since we start late. I'll start with this important slide. These are just a few headlines I collated in March of 2020, and these headlines are all talking about the doomsday scenario because of COVID. COVID had hit us suddenly, and the biggest black swan event of our times. Now, if you read these headings, definitely the thought would come to your mind is for capital preservation and, at least not go overboard in risk assets. Now, what happened after, 15 months is that we have seen the sharpest and most broad-based risk rally ever. The market is almost doubled. Global market is almost doubled in that 15 months period. It's something which we have not seen in global markets or our markets, that any market where we have seen the bear market and the subsequent recovery reclaiming the previous peak, it just took 9 to 10 months, and something which had never happened. Again, who would have thought that equity market would outperform fixed income market by over 70%, small caps would outperform in COVID environment by 40 to 50%, copper would outperform gold by almost 100%. So the point I'm trying to drive here is that COVID gives us a great lesson about two things. One is that forecasting is very difficult, and second is asset allocation is very important. You can't be having a binary choices when it comes to asset allocation, because future is extremely unpredictable. And again, COVID gives us great lesson of forecasting humility. Now, with this backdrop, let me jump into asset classes in general and talk about equities. So this is a chart all of us are familiar with. Chart of Sensex, upward rising chart, long term, we all know 13 to 14% CAGR over the limited history we have. But all good in the long term, but if you divide the market into the shorter time frames, say for example annual time frames, what we realized that there's no real pattern. The pattern which we saw an upward sloping, rising market over the very long term. In the shorter term time frame, it's more random. There's no clear pattern when it comes to asset markets, or in this particular example, equities. Now, not only there is a lot of randomness, but return of 1 year have probably almost no predictability for the subsequent year returns. So there is no correlation as such about the return of 1 year and the next year. Now, if you further break down the market into months and monthly, return of say Sensex, what you would notice is that there's far more randomness, absolutely no pattern. In fact, 40% of the time, market has given negative returns, and within those 40% of the time, out of the 31% of the time, market is actually given more than -5% return. So it's a lot of randomness, no pattern, if you divide the market in the short term. And this is a slide which is about the themes which have driven the market to the long term. As you can see, every 2-3 years, the themes changes, the sector changes, and the leadership have kept changing, many of which were not forecastable beforehand. So the point I'm trying to make is that, it's over the longer term time frame, it's predictable maybe, but if you divide the market or break the market into shorter time frame, it becomes extremely random. Uh, Again, the similar point, if you look at within one asset class, which is equity, if you look at small, middle, large cap, almost similar return in this, again, limited history of 16 years or so. But then if you can notice, there are periods where large cap have outperformed mid caps, and the other way around, the broader market have outperformed the large caps. There have been multi-quarter period of such incidents as well. So, we looked at the market randomness. We looked at, within our market, different size, how they behave across different time periods. If you look at this same asset class, but two different markets. So here I'm giving the example of S&P 500 in Indian market. Again, same asset class, but very different return outcomes. So decade of 2000, 2010, developed market did pretty poorly. Emerging market did very well. India being part of emerging market materially outperformed US market, which was on a point-to-point basis gave negative return the previous decade. The subsequent decade of 2000, 2020, US market outperformed every other market, including India, which was among the best performing markets. So again, there also the leadership changed significantly from a decadal perspective. This kind of pattern, of small cap outperforming over large cap, that keeps changing. Again, we have a very limited history. But the point I'm trying to make is that there's a lot of alpha that can be harvested. If you can catch this trend right, so you can catch the right market, and if you can, within a particular asset class, if you can get the sense of intra-asset class movement, that small cap will outperform or large cap would outperform, there is a lot of alpha to be harvested if someone can get that right. If you just broaden this discussion into other asset classes, say, for example, gold, equity, and Indian debt, same point I'm put across that, there are times when gold has outperformed Indian equity and debt. There have been times when Indian equities outperform both gold and Indian debt. And then both gold and equities underperformed sometime in the previous decade, and debt outperformed. So there is structural shift that keeps happening, and many a times these are not predictable. So same thing you would see in fixed income. So the broader point I'm trying to highlight here is that there is a lot of randomness, and therefore there is a need for a robust asset allocation to smoothen your experience toward long-term wealth creation. And why asset allocation work? For a very simple reason, because of the concept of diversification, which means if you can have two or many asset classes which have lower or if possibly negative correlation to each other, and both gives good long-term returns, but time to time one outperforms the other, you have a possibility of smoothen your journey to attain your financial goals. That's as simple as that. And what I'm showing it to you in this slide is you have domestic equity, overseas equity, Indian debt, and commodity, and I've taken gold here. You can see certain asset classes even have a long-term negative correlation. And this is only for a shorter term time frame. If you even on a longer time frame, similar relationship exists. And if you can combine assets which are uncorrelated, uh, you attain your long-term financial goals, and with lot of smoothness and return point of stress improves, and that's the power of proper asset allocation or diversification. Now, one asset class I just mentioned, I'll just talk about, we discussed about income generating asset class like equity and debt. Why gold? The reason for gold is as definitely it has demonstrated quality of being less correlated with other asset classes. And why gold works, to my mind, because people find there is a value, although there is a no income argument to it. And typically, consider gold as a kind of insurance that you buy when things go wrong from global policy perspective. Some instability is there due to policy adventurism in the form of higher inflation or deflation. And in those uncertain times, when some policy error happens, gold tend to outperform. It tend to outperform equity, power market, global markets. It tend to outperform even fixed income. So it has demonstrated great, diversification value, and therefore it should be a part of your asset allocation. But now there are other asset classes, new age classes, asset classes, which are also challenging the role of what gold has. But still, given the past history, gold can be also a part of your asset allocation mix, although cannot be a dominant part because it's not an income generating asset. With this kind of background, the first stop, is a case or what I call a static equity, static asset allocation mix. I mean, it all depends on whether you are growth-oriented investor or you prefer stability of in your portfolio. But you can have this mix of domestic equity, overseas equity, commodities, and debt. And what you will have is a portfolio which may give you a pretty good volatility adjusted return. Why international equity? As I explained, that there have been periods where global equities have materially outperformed our market. Part of the reason is that certain profit pools are not available in Indian market, like newest technology and all these mega caps that we have globally on the tech side. Some of the things on commodity side and tech side, despite the fact that our market has pretty diverse profit pool, you may not find in Indian market. So overseas equities in that sense provide a good diversification value. So you can have a portfolio which is predetermined in terms of weight, and you will probably have a decent risk adjusted volatility adjusted return. And that's one way to do take advantage of diversification asset allocation. But how about a case for dynamic asset allocation, wherever and you can choose the right asset class which is going to outperform? You can do that, and you can even try to attempt choosing the right sub asset class. So, for example, within equities, if you can harvest that alpha, wherein say large cap is outperforming small cap or small cap is outperforming large cap. If you can be there in the right asset class at the right time, you can harvest something more. So that possibility exists outside of static asset allocation technique. So this is where I'm coming to the systematic dynamic asset allocation. Now, there are two methods preferred by global discretionary asset allocators. One is through top-down or macro method. So they look at economic cycle, where we are in economic cycle, and based on that, people determine whether it's the right time to be in equity or fixed income or commodity or in cash. So, for example, if you are in a situation where growth is expanding, inflation is rising along with growth, interest rate is on a slightly upward trajectory, liquidity is strong, this is kind of reflationary environment is suitable for reflation asset or assets like commodities and equities. They tend to outperform debt assets like bonds or cash. Just in contrast, if you are in a contractionary phase or recessionary phase, wherein your profits are coming down, GDP is on a declining trend, there's deflationary kind of pressure, interest rates are actually coming down, which favors bond, but asset classes like equities and commodity underperform. Now, this is very intuitive. Everyone knows about these different phases of asset cycle. The problem is, how will you determine where you are in the asset, the business cycle? Now that requires you to be right on multitude of multiple variables, right from GDP to interest rate to industry consolidation, currency, inflation, a lot of things. In fact, in COVID, you had to be right on whether the vaccine will come, how effective the vaccine would be, so on and so forth. So you have to be right on a lot of things. But still, the very basis why people prefer macro or top-down asset allocation is that there's a concept that says history doesn't repeat itself, but it does rhyme. So if you take the leaf from the history and you understand what kind of environment is currently prevailing, you can take that bet on a particular market, a particular asset class. The challenge here is that incrementally, macro investing is becoming very difficult. Cycles are getting shorter. And just to give you an example, even if you are right on a lot of these macro forecasts, which to my mind is very, very difficult, and I've been practicing it for 15, 16 years, sometimes asset classes would behave very differently. In COVID times, history is not only, it's not repeating, it's not even rhyming. So, for example, I'll give you an example of just 10-year rate, which is very much discussed. If I would have given you a scenario where you have a GDP growth over the next 12, 18 months, which is probably the strongest in decades, inflation and inflationary expectation are much higher than what we are used to, 4-5% actual inflation, 3% kind of inflationary expectation. Debt levels have significantly gone up and debt will further go up. What would you have thought about 10-year interest rate in US? Definitely not 1.2% for 10-year, which is prevailing today, right? I can give you many such examples where even when you are right on macro, ultimately asset classes would behave very differently. So to my mind, it can be done, top-down driven asset allocation, but it's very, very challenging and incrementally so. And therefore, I go back to this um, old chart of mine where I look at, the forecasting ability of consensus at large. This is for MSCI India. These are 2-year forecasts, and people, the consensus who have forecasted the MSCI India ETS 2 year ahead, and what is the actual outcome. You can see, consensus in general have probably a lot of optimism bias, and they are not usually right. And if they are not right, it clearly says that forecasting is difficult. These are the best minds. Still, the ability to forecast is very difficult. And therefore, it's a lot of times said that forecast tell you more about the forecast than of the future. So the point here is that macro and forecasting is very difficult, and even if you're right, odds of you being a successful asset allocator is difficult, incrementally very, very challenging. The other thing which comes in your way of successful discretionary asset allocator, being a discretionary asset allocator, is volatility. What we all know, and it's very basic knowledge, is that we are all taught that we need to buy at a lower valuation and sell at a higher valuation. So valuation can be a great way to time the market, get into the right asset class, and so on. But the problem is because of the volatility, these emotional biases creep in, and biases like greed, fear, envy tend to, force you or even the seasoned investor make mistakes, and they don't follow this sell and buy low rules, and therefore there is this gap between what an actual investor earn and what he or she can otherwise earn if he or she would have invested for a longer period. So volatility definitely cloud your judgment, and and volatility, as we all know, can come from anywhere. Like COVID came from nowhere, for example, right? So valuation, people think, is a good way to deal with market volatility. This is another very popular way of doing asset allocation, right? But the problem is again that we need to understand that it's not easy to use valuation-based asset allocation. Why? Um, just look at this chart of this is MSCI India 1-year forward T. This is my preferred valuation indicator. Now you can see 16 years ago, the 10-year average of forward multiple for our market was around 12 times. Today it is 17 times. So it has been constantly rising and the average is not static. Second, if you look at the other parameter, price to book, where you've not seen that kind of continuously, that multiple going up. The reason being there at that side is that ROE has been continuously coming down. So it's not giving you the true picture of the value in the market. So different multiples will give you different signals at different point of time. So there's no complete multiple. The second point is uh, these multiples, in our market have been secularly rising for two basic reasons. One is obviously we all know the interest rates, right? If interest rates are low, the opportunity cost is low, you are willing to give higher multiples to equity as an asset class. So it's not one number which matters. It's always in relation to the interest rate, which you have to look at. If you look at the interest rates, they have been coming down the last 20, 30 years globally, as well as in India, and they have put in upward pressure on valuation. Second and very important aspect when it comes to valuation is the composition of the market. Now, if you have a market which has more cyclical sectors and companies which have more debt, uh, more volatility in their earnings, difficulty in predicting their earnings and revenues, you are not going to give that kind of market higher multiple. And if the same index over the period would comprise of companies and sector which are more defensive in nature, high ROE, less debt equity, more secular businesses, you would tend to give higher multiple to that market. So same market at different point of time cannot be compared with one multiple yardstick because the underlying fundamental has completely changed. And as I explained you, that interest rate itself will be a big determinant of how much valuation you want to give to the market. So 20 time 1 year forward multiple can be cheap if interest rates are at rock bottom. And 15 time forward multiple can be expensive when interest rates are in double digits. So the point I'm trying to make is that while valuation may sound intuitive, but again, not practical way of doing allocation, because if you just see these two charts, barring the crisis period, which is 2008 taper tantrum and COVID crisis, you would have hardly got a chance to remain invested in the market or be participative in the equity market in terms of allocation because valuation was secularly rising, as I've shown in these charts. So what should you do? And again, the last point on valuation is that if you have a shorter term horizon, interest rates are not, valuations are not a great signaling tool. So starting point valuation don't matter or don't have great explanatory power. If you have a shorter term time horizon, unless you have 5 to 10 years of time horizon, starting point valuation may not be a great, explanatory tool. Over the long time period, like 5 to 10 years, as you can see in Indian market or in global market, valuation comes handy, but in the shorter time frame, it doesn't. So the point is, if you have problem with two prominent method, which is top-down method and valuation-driven method, then how can you do asset allocation if both the methods have an issue? To our mind, I think you can have a success if you are open-minded and if you can try a multidisciplinary approach, which not only includes the fundamental factor like valuation, but other factors also like price momentum and certain behavioral and macro factor, which all of which I'll just touch upon in subsequent slides. Now, when you combine these factors, few things you have to keep in mind that each of these factors on their own should be logical. With basic, you should understand that why it should work. They should be complementary to each other, and all these indicators should be available at a reasonably high frequency, otherwise of no use to use individual variable. Now, this is an example of multidisciplinary approach when it comes to asset allocation between two asset classes. And one of them has to be equities because our starting point is equity valuations. So when will you have higher allocation in equities in this kind of setup? When you have lower equity valuation, whichever valuation parameter you have in mind, higher price momentum, which means market upward trending, and favorable macro. And we will discuss a couple of macro data points which can be very, very useful when it comes to devising your own asset allocation solution. So if you have favorable macro, strong price momentum, and lower valuation, you can have very high equity allocation and vice versa. Now here, what you need to keep in mind is that there has to be dominant asset class, depending upon whether you want growth or stability in your portfolio. For example, you need long-term growth in your portfolio with some stability. Equity can be that dominant asset class, and weight of the other asset class. It could be debt, it could be gold, will be a function of the residual weight, which is coming out after excluding, after considering these factors for equity allocation, whatever the remaining weight you assign to that, receptive asset class. Now, again, I go back to the previous problem, that which valuation parameter. So again, you need to devise your own valuation parameter. And again, the diversification benefit would come handy. So you can take any valuation, conventional valuation parameter. For example, I prefer 1 year forward PE because it takes into account return on net worth, it's forward looking, and it's relatively more complete, although it's not an all weather signal. But you can't only look at conventional method like price to book, price to earning, or price to sale. You have to look beyond that. And in your valuation tool, you must include something which includes the impact of interest rates. So as I explained, equity valuation may look higher on an absolute basis, but asset allocator has to keep in mind where the interest rates are. So on a relative basis, equity may be attractive, interest rates are low. So you can, for example, look at this equity risk premium framework, wherein you are considering what is the prevailing earning yield, which is the inverse of PE ratio, uh, and the bond yield. So if the gap is higher, you want to allocate more to equity. If the gap is narrow, you want to allocate less to equity and to more to some other relatively more defensive asset classes. So a combination of ERP plus some conventional valuation measure will give you a very robust valuation parameter. Now, if someone is coming from Mars and there are a lot of talk about, linear going to space, if someone is coming from space and want to invest in uh, asset classes, want to do asset allocation, how would he or she do that? Very simply, there is a famous saying that ride the winners as long as you can and cut your losses as early as you want, as you can, right? And the way you can do it is through a very, very robust, but not very intellectually intuitive, variable called momentum. So you keep riding your winners till they are winning. And once they stop winning, you get into some other sector which is winning. So I'm giving you 5 different lines here. Um, just consider them: large cap equity, mid cap equity, small cap equity, debt, and gold, just to hypothetically as an example. And whichever one or two asset classes are outperforming, you be overweight in that, and whichever are underperforming, say in 1 to 6 months time frame, and whichever time frame you want to have, right? Uh, but be with the winners. And again, in your multidisciplinary approach, if you combine momentum with valuation, it will keep you in the game even from a shorter term time frames. Now I come to the other variables, which includes your macro variables. And before that, I want to touch upon a very important slide of this slide, that when we think of India and equity allocation Indian asset, you can't take your eyes away from global markets because they're far more integrated, both from fundamental perspective and valuation perspective than we think. So whichever things work globally, whichever asset class is doing well globally, the same pattern is repeated in our market. So if you look at the lower left-hand chart of Indian market valuation, 1 year forward valuation to global or emerging market 1 year forward valuation, there is very, very high and consistent correlation between this ratio. The reason are twofold. One is that FII, which is the right-hand side upper chart, FII is within the two institutional investor, FI and DI, barring the period of disinvestment, couple of years post that disinvestment. Um, FIs have been far more dominant player when it comes to deciding the fate of the market. Let's accept that. And again, they have become very important, right? That is the one part, the liquidity part, the risk on, global risk on, risk of environment, that part. The other part is, the fundamental side, close to 50% of our earnings, if we exclude banks, probably more than 50% of the earnings of large cap, even in the broader market, comes from sector which are either global demand dependent, or they are dependent on global pricing. So it is very important to keep in mind that whichever kind of sectors performing well globally, same would get reflected in the outperformance in our market. So if metals are doing well globally, the same you would notice in our market and vice versa. So a lot of earnings also come from global market. So keeping an eye on global liquidity, global interest rate, global sentiment, and global fundamentals is very important when it comes to asset allocation in our market. Now, continuing with that point, the one relationship which has not broken during COVID, and by the way, a lot of correlations have broken in COVID, is dollar, right? Weak dollar is equal to strong inflows in equity and asset class or emerging markets in general, right? So that relationship is very, very strong. And this is one of the very important, simple, time-tested, data point which one can use, that whenever dollar is strong, um, be underweight in equities, and whenever dollar is weakening, which will happen in a environment where interest rates are low, liquidity is abundant, that kind of environment, you should be overweight in Indian equities. So how does it look in terms of our market perspective? In this chart, this is a chart of trade weighted dollar index, which is on inverted scale. On the right hand side, the orange line, you have BSE 500, the broader market of ours. You can clearly see there is a great inverse relationship. Weaker dollar is equal to stronger Indian market and vice versa. Now, another very powerful global macro tool is commodities. So you can look at commodities. Copper is a great single most reliable commodity here. But you can combine certain commodities, and you can find that whenever these commodities rise, equity market also performs in line with that, because it's a sign of both global demand as well as global liquidity and risk on environment. So you can see the amazing correlation of this global demand indicator, global commodity proxy, to our market performance. And again, what you need to look at, these may not give you great leading signals. You have to be vigilant. You can determine your moving averages, and whenever the commodity and dollar, whenever they are above or below certain moving average, you can increase or decrease the allocation in equity accordingly. So these are concurrent indicators, but then you don't have to forecast. You just have to rely on the historical relationship, strength of relationship that dollar and commodities have with our market. Now, what I told you so far is about asset allocation, where valuation is at the fulcrum or at the center, and you have technical parameters like momentum, and you have parameters like macro and behavioral parameters like dollar and commodity and so on and so forth. But what about a strategy where you don't require valuation, and valuation may not be very useful in certain cases? And if there is no valuation, how can you do asset allocation? What are the possible solution, wherein you can do very successful asset allocation without any fundamental parameter like valuation? Now, this comes into play when you have to do allocation beyond two asset classes. So if you are doing asset allocation across, say, 3 or 4 markets and 3 or 4 asset classes, and not only that, you are also doing allocation which is intra-asset class. So you're not only determining how much equity, you also want to determine how much allocation should go to large cap versus small cap. So the first point is, if you're doing multi-asset allocation, that means equity is not the dominant asset class, right? You are open to have 0 to 100%, say, debt, gold, international equity, or anything, right? So what you need is something which is not valuation based, and therefore, then only you can apply, and all the variables should apply equally to each of the asset class. So there, parameters like momentum, parameters like macro, behavioral factors, you can come up with your own, debt indicators or sentiment indicators, But momentum and dollar or commodities, these three can do a phenomenal job, and you don't need anything else if you don't want to have valuation and your problem set is beyond two asset classes and it is a multi-asset classes. Now come to a very important point. I highlighted that there's another alpha which can be harvested, is the alpha of choosing sub-asset class within an asset class. So intra-asset allocation. So in this case, equity, within equity, debt and small cap and large cap. Again, you can see that valuations are not very, very effective. Um, and I personally believe that, not that, small cap, despite, trading at no discount to large cap, that was probably not an anomaly. And I want to highlight very important fact that a lot of time we think that small caps have to always trade at discount to large caps. That may not be true. I mean, any trend valuation for any size category should be a function of the composition of that index, right? If small caps have company sectors and companies which does not have very high debt equity, small cap companies ROEs are higher. They are representing sunrise sectors, new age companies. Um, they are far more ESG compliant, for example. In all these cases, and they don't have any sunset sector, right, or terminal growth issue, then it's not necessary that you pay, discount to small cap just because of the illiquidity, premium. The point I'm trying to make that, even in US, we have seen that small caps have traded for years at a premium to large caps, and now for last 12, 15 months, they're trading at discount. So any size category, because of the fundamental factors, I think they can trade at discount or premium. So one should not be too straitjacket about these things. And secondly, as I am explaining it to you, valuation doesn't work, but and many periods fail terribly when it comes to choosing between large cap or small cap, purely based on the earnings spread gap between these two categories. Now, so how if you look at this particular slide, very interesting slide. I was talking about dollar and commodities helping you determining the asset location. Um, if you just see the trade weighted dollar, and if you want to determine whether to be in equity or Indian debt, rising dollar means you have to be in debt over equity, and falling dollar means you have to be in equity over debt. Similarly, if there is a trade weighted dollar globally is appreciating, you should be in large cap and you should be underweight in small cap. Similarly, if you look at the commodity indices or the hard commodity index, or the commodity composite, which I highlighted, that demand indicator can also be a great tool to determine whether you should be overweight debt or equity in our market. So, for example, whenever commodities are rising, you can be overweight on equity, and whenever they are falling, you can be overweight on bonds for the simple logical reason that they represent inflationary stroke reflationary environment on one side and deflationary environment on the other side. And you can, extrapolate it to in fixed income. Even fixed income, we have seen whenever commodities are appreciating, the short end tend to outperform the long end. And whenever there is an other way around, when dollar is appreciating and commodities are down, long end of the curve, if you take the duration in your portfolio, you tend to generate better returns versus being on the short end of the curve. So I think these simple macro, parameters, if you combine in terms of proper moving averages, without forecasting, you can do good asset allocation. This is one of the final slides. Slide about one fund indicator. Again, if you want to do intra-asset class allocation, you are looking for a contra signal. This can be a great contra signal. This is Sensex to total market cap ratio. Whenever Sensex to total market cap ratio comes down to 40%, that means the broader market has materially outperformed. That is the time you should start warming up, get into more large cap and reduce allocation to small and mid caps. And when it goes to 50%, that means market has been narrow. Few companies have outperformed the rest of the market. That is the time you have to, start reducing the overweight in large cap, start increasing the overweight in the small and mid caps. And it has historically worked very well. as a ratio. We call it turnaround indicator. So you can come up with multiple things. Just to summarize all this, you know, um, in terms of diversification benefit, all three approaches will give you diversification. Yes. In terms of simplicity, in static allocation, there are predetermined kind of weightages to each of these asset class. So it's simple. When you come to dynamic asset allocation, obviously the complexity increases. If you want to do, among asset classes, equity-based asset allocation solution can only be possible and effective if you have only two asset classes and you're not looking to do asset allocation in terms of intra-asset classes, like between large cap and small cap, or long end and short end of the fixed income securities. But asset allocation without valuation parameter, relying on technical, behavioral, and macro parameter, that can be applied across many asset classes, and also intra-asset class asset allocation can be done there. You have to keep in mind few other factors like churn, cost, taxation. It's least in static asset allocation, and probably it is the highest in more dynamic kind of approach, which is multi asset class allocation. There probably the churn is highest, cost is probably highest, and obviously that means the taxation impact would be slightly more different from the other two approaches, particularly the static approach. So this is the final summary slide. All I'm trying to explain here is that uh, asset allocation is important. Two main techniques that we have, top-down technique and valuation-based techniques, are not very useful. Don't I don't believe I believe that it is possible to do discretionary asset allocation, but I think it's very, very difficult and challenging. And to avoid forecasting errors, to avoid behavioral biases, you should rely on models. Ultimately, you need to keep in mind that you are making the models. You have to be very, very honest. And then your model should be entirely based on the mandate you have. So if you are a buy and hold investor, long only investor, where your rebalancing frequency is very long, where you can take, we are fine with long period of underperformance, and you're fine with that, your mandate allows you, then valuation should be at the center, at the core of your asset allocation approach. But if you can't tolerate periods of underperformance, then for a frequent rebalancing kind of approach, value as a factor is not very effective or useful. Um, don't cheat yourself. I think you should. That is very important. Uh, Test your parameters very carefully. All these parameters should be persistent, pervasive. They should work across markets. Should have a very long backtesting history. And here I want to highlight that whatever we try to do in our market, in global market, just understand one thing, that we don't have enough history. So therefore, it is very important that you should be very, very honest about the data, and don't come to the conclusion with fewer data points and limited history. Diversification helps even when you're choosing among the factors. The best strategy should not have more than 7, 8 factors. You can discover and invent factors. We, as a practitioners, we try to do that all the time. So you can come up with some novel factors, and you never know, you can discover something great and unique. Be open-minded, as I said. There's no secret ingredient. There's no final formula. Keep checking time to time, periodically, whether your approach is still effective. All these factors which you have combined are giving you the same synergy which they were giving in the past. Find different ways of exploring new factors, combining new factors. So there's no end. So it may be a passive approach, but it's really exciting. And the last but not the least is that while rule-based investing means that decision making is at the strategy level or at the model level, you need to have a great temperament, because many times it will test you. No model is perfect. It's just that you are trying to improve your odds and reducing your biases. That will also test your patience, and you should not. You should keep checking whether the model is effective. Just because you're underperforming, you should not, doubt yourself or your process. You require great temperament, and then if you are interested in asset allocation, you just do it. Whatever I explained, there is much more to it. And what I have realized in the last 3, 4 years of really practicing it in real life in terms of product. But there's a world of difference is knowing and doing it. So when you do it, you will understand the nitty-gritty is challenging, and it's a very, very exciting and subject. And That's where I would like to stop my presentation. And if there are any question, I'm happy to take. So over to you, Srinivas.
Yeah, so this, thank you so much. There's so many questions actually. For the questions itself, maybe we could have 1 hour. So my request is, if you can, give not more than 1 minute to each question, so that we can do a lot of coverage. Uh, Very interesting presentation, very insightful. Lots of rules. Even writing each of these rules, probably it will be 40 rules, or that we have to write down. One thing, let me get straight to the point. Saloni is asking, what is the ideal asset allocation as of now? Now, we don't want to know your formula. We are not here for knowing the what's. You've talked about many indicators. So how should one think about asset allocation for different types of investors? Right? I mean, a 30-year-old, 70-year-old, and how does your static dynamic asset allocation model, work with these personas?
Quick answer to that is, if you are buy and hold investor and you don't want return, or redeem your money over the next few years, and you have to keep investing systematically, your asset allocation approach should be more contrarian in nature. You don't need any momentum indicator, be it technical indicator like momentum, or indicator like macro indicator. You can make entirely contrarian indicator, wherein at every dip, every correction, you increase equity allocation and keep investing for eternity. But the point is, no one likes the drawdown, no one likes underperformance and other people making money or neighbor making money. If you are looking for smoothness in your overall portfolio and you want more consistency in return, then you need to have more hybrid kind of approach, multidisciplinary approach. Then you need to include momentum factors, technical factors, macro and behavioral factors. So that's a big difference. Contra for buy and hold forever, to enhance return. And if you have a shorter time frame, you are more interested in smoother return rather than the end return. Then I think you need to combine technical and behavioral factors.
So the dynamic asset allocation model that you referred to, how frequently does it rebalance?
It all depends on your comfort and the kind of parameters you are choosing. If you are choosing momentum as one of the factors, then the thing is, momentum is not very effective for a longer term time frame, right? So you have to have rebalancing frequency at max 2.5 months, right? You cannot have more than that, because then momentum won't work, right? So if you have factors which are more, such nature, more momentum oriented, be it macro momentum or price momentum, then the forecasting frequency has to be between 1 to 3 months. And if you have more contra kind of approach, it can be once in a year, or rather than, I would say, time based, it could be based on the opportunity at hand, whenever it comes,
Right.
once in 1, 2, 3 years, whenever it comes,
Right.
either in terms of extreme overvaluation or undervaluation.
Right. So Navneet Ajmera, one of our senior members, he says that this presentation is very insightful. Thank you very much.
Thank you,
He's
sir.
also asking this question that, how does he build? How can people build conviction from what you have you back tested this, or you mentioned you have been doing this for 4 years, right? So, or
So one
five
of
years.
the one of the product we have, where we kind of have introduced some of these concepts and we keep refining the approach, is we have a balance advantage fund. It's a two asset class fund, where in equity and debt. But but the backtesting period is very long. We have been doing it for 20-25 year period for our market, and for other markets, same factor. Because if the factors like dollar and commodities, there you can backtest for 40-50 years, for other markets like emerging market, etc. So we have backtested for longer period. But as I said, you should know your comfort, know your mandate, and be very sure in terms of which factors to include, and avoid factors which are giving you similar signals. So overlapping and multicollinearity has to be avoided. And it has to be simple. So we don't have very complex model. There can be, I mean, you can make very, very complex black box kind of model. Ours is a very simple approach. If you can't do it in Excel, I think it is complicated.
Right. So going to that Excel versus complicated, are you doing all of your stuff in Python or what are you doing?
Python.
Okay. So what do you exactly do in Python?
Basically, it is just to find the best combinations. We have some uh, you know formula, and we just do a lot
Okay.
of iteration, come up with that. But what we try to avoid is fitting for sure. It's not that we are trying to find the best fits. It's just that we want to, because see, for example, for a commodity indicator, we would have analyzed more than 25 commodities, and they should represent emerging market, they should represent developed market, they should represent even that part of global liquidity and growth which are beyond emerging market, or emerging market, beyond US, beyond China. So
Right.
so when you combine them, so you need to do a lot of data churn, and therefore you need something which is more powerful than Excel. So yeah, that's
Yeah.
where Python comes in.
Yeah, so Abhishek has asked this very pertinent question. See, many of our members will not have access to, so I mean, quite a big proportion are working with big banks and they have got access to Bloomberg, etc. But many of us, don't have access to these data service providers. So, how do you get the data for this?
See, whatever I have told you, all the data probably is available in, say, for example, trade weighted dollar. I don't use, by the way, DXY or INR USD because I don't think both of them work. But for trade weighted dollar, which I showed you, you can find this data, longest history on St. Louis Fed website. A lot of data you can get from there,
Absolutely.
which is
That's right.
freely available.
Yeah.
So I think data in this world is not a problem. Data or knowledge, and I think I can tell you, there are a lot of shops. There are very exciting people on FinTwit, which you can follow and read, and and you can do a great job by learning from them and getting your hands dirty. You can
Right.
come to your
Right.
version of your quant or your
Yeah.
certification.
Let me come to a set of quick fire questions. Okay, these are from people. So the first one is Harshit, and there's another person. I missed that person's name. How come you're not included cryptos?
To this, it does not have history. As I said, it has to be
Okay, great.
persistent and pervasive. I don't have history.
Yachit is asking, I want to allocate commodities. So when you say you've looked at 25 commodities, how do you really do that? How do you get exposure to commodities?
So I'm looking at commodity both to determine the global demand pattern and global liquidity pattern.
Okay,
So which are the two important countries to your mind? US and China?
that's right. Yes,
What is most important in US?
there's a demand.
Housing market, right?
Yeah, that's right.
Housing market, right? So you can, for developed market housing, so you can find some commodity which is linked to housing. What is important in emerging market or China? Infrastructure, right? More infrastructure, more hard commodity metals. You can identify some metal for that. So you have to combine these kind of things. It has to be logical. Just you can't only rely on correlations, right?
Exactly.
Everything has to make sense at a economic logical level. So you combine these things, and I'm sure. I don't think I have the best solution. I'm also in this inquiry, and that's what I would like to suggest to everyone who's listening to this conversation, that there is no end formula or magic formula. You keep trying. Um, Everything is available. You just have to have the right questions. Answers are easy.
Right. So both Saloni and Rahul, they have talked about, or they're asking really about central banks, and do we really, I mean, do you see a step change happening here, right? I mean, there was 2008 and there's now 2021. So there's something that is happening with central banks and their mandates. So do you see that breaking down? I mean, should we believe in what is the conceptual thinking on your side in terms of the phases for asset allocation? Because presumably you build this over certain history, and that history itself is breaking down.
First of all, I clearly mentioned that I don't believe in forecasting. I don't think I can do that. I don't believe anyone can do that, to be honest. You should know that what matters. So if central bank succeeds or fail, it will have a reflection on price momentum. It will have a reflection on liquidity parameters like dollar. It will have reflection in commodities. Uh, and even for valuation, as I said, you can have a conventional valuation signal or tools, and then you can combine them with the equity risk premium kind of model, where you have to look at the relative attractiveness of an asset class from versus interest rate or opportunity cost. So when I think of these things, I understand that future is far more uncertain. It's becoming far more complicated to judge what will happen 12 months, 24 months on the line. But as I said, all the parameters I have should be able to deal with these kind of uncertainties, because um, they are not any environment specific. And the certain thing changes, my allocation changes automatically. You choose your factor which are not environment dependent.
That's right. Before I go to the next question, I mean, which is actually Prashant Tandon, he's got a good question on, in an environment where, rates are going, to lows, right? I mean, lows meaning, you now got bank rate at 4% and 3%. How do you allocate to bonds? How do you allocate to fixed income? So you're pushed to equities, right? Your risk profile is essentially pushed.
Absolutely, that is one. And the other choice is when you have such a steep yield curve, right?
Yes.
And that the supply of bonds is going to be high, and inflation is a bigger challenge than deflation, right? That inflation risk, right? It's possible that the next policy action, whenever it happens on the tightening side, right, it cannot be easier than what it is today, because real interests are already very negative. uh, if I don't look at the rule based allocation, I apply my mind, obviously I want to be in the short end of the curve rather than on the long end of the, because there is a huge possibility of capital loss,
There's a
right?
duration risk.
Absolutely.
Yeah. So Shardul, he's asking about, and I think Mandar as well. No, is factor momentum, right? I mean, I saw one of the titles of the slide. It's very interesting. The title says, trend should be a friend and listen to momentum. So how do you listen to momentum in practice? And can you give 1 minute of your time on momentum factor?
Momentum can be, it's very simple. You have two asset classes. Suppose you
Right.
have two assets. One is, and you have a finite time period of say 6 months. One asset class have outperformed the other in 6 months time frame. One is up 25%, other one is up 20%. So momentum says that whichever is outperforming, you go with that, you be overweight in that. And it's a very crude way of explaining. There can be multiple way. You have a good momentum, bad momentum. You can combine it with volatility of the underlying security and asset class. You can do a lot of things. But the real point here is whichever is winning in a certain time frame, you go with that. That's very counterintuitive to say valuation, right? In valuation, you say, buy low, sell high. Here we are saying you keep buying who's winning, irrespective of valuation, etc. The idea here is that you're going with the wisdom of the market, and you are doing actually risk management, because your momentum factor is between 1 to 6 months, whichever, depending upon what frequency you want to look at. So you're looking at moving averages of these things, say for a dollar or commodities. If they are above a certain moving average, means the momentum is positive. If they're below a certain moving average, means the momentum is negative, and accordingly you can be overweight or underweight on risk asset versus the safe assets. Am I clear to you? It makes sense to you?
Yeah, so yeah, I mean it does. We can spend more time on that, but I mean I would be attracted to go to my next question. So imagine many of actually the people who have been asking questions, they are wealth managers. So
Right.
how should they, and they will be having a range of clients, right? High net worth clients, retail clients, institutional clients, and so on. So presumably the model that you're suggesting right now, right, which is having all these, it's a sophisticated model meant for high net worth individuals, right? So is that right?
Not necessarily. The good thing what has happened is that you have this LTCG. So, right. So even if you book get in, get out of equity soon, within 1 year, there's not much difference now between the short-term capital gain and long-term capital gain, and you will still end up paying lesser when it comes to equity in terms of taxation on a capital gain versus the other. So, it used to be less rewarding to churn frequently till 3 years back, but now it is actually more attractive to do that. Um, but the point is well taken. You should know what kind of investor you are, or what kind of clients you have. So if your clients are very long term oriented, they don't care about the short term underperformance and outperformance, but yet you want to smoothen their experience without churning it too frequently, then what you need to do is keep a valuation at the core of your asset allocation, but try to identify the extremities of the market. So one indicator I showed you, Sensex to total market. It's a contra indicator, right? It may not come for 3 years, but whenever it comes, do listen to it. So the contra indicators also, you can have three, four, or five of them, not only valuation, and at an extreme level, you can adjust the asset allocation of your client. So you are not compromising on taxation, you are not doing it frequently, yet at important junctures, you are taking advantage of mispricing, whether in terms of extreme overvaluation or undervaluation. So that can be done. The shorter the time frame, I again repeating, you need to include variables like technical variables like macro and momentum. The longer the time horizon, prefer more contra indicators like valuation.
One quick question. So, in using dynamic asset allocation, what is the extra portfolio turnover compared to a static allocation? And, what are the advantages, disadvantages of that?
So as I said, obviously static allocation is better in that sense, right? But then uh, it's only better if you have more than 65% always in domestic equity,
Right.
right?
Yeah.
If it is not that, then you are into debt taxation if you have international equity or gold or debt, right? So it depends, starting point, whether you're a growth oriented investor or you prefer more stability. That is one part. The other part is, as I explained, with the introduction of LTCG, the taxation part at least is not a big deterrent, but definitely cost goes up if you churn more frequently or do it more dynamically. But then the advantage here is that you smoothen return. In fact, momentum, which is responsible for a lot of churning, is a great tool to enhance your long-term return, because it is cutting the losses early and writing a winners, right? So it not only, yes, it increases more churn. There is some cost element, but my experience is that a lot of the intellectual people may not agree with it. It is probably the most powerful way of doing asset allocation. If you have to choose only one factor between valuation, macro, momentum, I say just go with the momentum. And that's why I started with saying that someone is coming from Mars and know nothing about it. Momentum anyone can do. Is on an Excel, anyone can do. You don't need any data, right?
So how much of the job can be done by the machine, Ashutosh, compared to because looks like you've got all the rules here. So put them in a machine and let the machine run it.
I am not equipped to. I'm I'm not into machine learning AI driven solution.
No, I mean I'm
I'm
saying simple machine, right? So you've got these heuristics. The trade weighted dollar goes down. Time to invest in equities, have a cutoff. The machine could do it, right? No
Why
machine
not?
learning. Yes. So
Why not? The only thing is who's running the machine. I think we exaggerate the machine learning or AI thing. Ultimately, you and I setting the rules. The output is as good as the rules that you and I are setting, right?
right.
And then you have every now and then black swan and white crow event like COVID, right? That
Yes.
market not only goes down sharply, recovers very sharply. So all your algorithm will go for a toss. So
Right.
it's not that you make it and done with it. algorithm only learns from history, and as I said, it's not that history will always rhyme.
Right.
So it is always man plus machine. But once you have decided what you want to do, then don't interfere with doubt.
Right.
That is cheating to my mind, and that is a clear recipe of the failure. And
Right.
that's why the last point I said, temperament is the key
Right.
more than the science.
Right. So in this you've not included derivatives. I saw,
No.
right. So you kept it simple. You kept life simple.
Yeah, I mean, you can make it as complicated as possible. Trust me. But the point, so the moot point of this discussion was to make people aware that
Uh,
there is the world which is beyond macro and valuation, which is possible. Because I personally think these are the only two things that people talk about. Either
right.
they talk about macro or they talk about valuation. And to me, I mean, how would you know? 20 years back, did you know that market would be comfortably trading at 1920 time? I remember 2007 when I joined this organization. We used to say 11 time you buy, 17 time you sell. Now
Yeah.
17 time is the average,
That's it. That's it.
right? So the whole goalpost has changed, right?
Yes.
So my whole point is that you have to be abreast with the time, keep refining the model.
Unfortunately, people have to become more agile, and that means our members will have to play an active role in hand-holding their clients uh, and telling them, listening to the market and translating that into advice.
Absolutely, yeah.
So that's a fantastic session. I wish I could. I mean, I'm sure I'm actually holding back your evening. Thank you very very much for doing this, Ashutosh. One last question is that are you planning to write a book? And if not, where can apart from the presentation that you have so kindly and generously shared, what books can people read?
I think there are some legend, some demigods when it comes to world of fonts. So you look at the AQR website or Alpha Architect. Uh, um,
Research affiliates.
research affiliates.
Yeah, so Rafi
That's
has
another.
got their website has got a simulation game kind of a thing where you can simulate how each asset would perform or outperform or underperform across
Mhm.
countries. But sorry, yeah, go on. Yes.
The only point I would say is that, and this is where I have also learned a lot from a lot of these sources. You have to customize to your market. The valuation parameters which works globally, they don't work here.
That's true.
India is a very different kind of market when it comes to equity market, particularly the fixed income market. It's a classically a case of financial repression. So no macro fundamental work when it comes to choosing between long and short end credit or So you need to customize it a lot. You have to understand what they are saying. You have to understand the basics of your market and then make it. Just don't copy it. That is the only
Yeah. So,
advice.
so so you mentioned two websites and which books you mentioned, like
See, the life-changing book for this subject of rule-based investing for me was What Works on Wall Street by Jim O'Shaughnessy.
okay,
Yeah, and they have their own shop, uh,
okay,
O'Shaughnessy Asset Management.
yes,
But that book is like, to me, it's like a Bible. And then, as I said, AQR, Research Affiliates, Alpha Architect,
there's
there
lots
are
of
so many. There's no dearth of people and people, and in terms of asset management company, let me recommend Rebecca or FTS, SE or BlackRock. You will find a lot of material there also. But but customize it, imbibe the learnings, and create something of your own. That's where the fun lies.
Right. Thank you so very much, Ashutosh. It was a pleasure and privilege to have you on this forum. We are really grateful for taking time out and doing this presentation. And thank you to everyone who's logged in today, who's registered. This webinar will be available and for viewing on the website. There's lots of presentation material. Ashutosh has generously and kindly agreed to give and share. Don't plagiarize it. Use it carefully. I know you won't and stay safe and be safe. See you all soon again. Upcoming webinar is on CIO's Insights. Harshad has put the dates on the chat. See you soon. Thank you.
Thank you. Thanks, Shiva. Thanks, everyone.
Thank
Stay
you.
safe.